everyone. You're watching The Money Show. I'm with you, Kavita Thapliyal, and this is the show where we help you strategize better for your financial life and for all your financial goals. This is the show where we answer your portfolio queries as well. So just in case you want to note down our number or maybe just reach out and you need our experts' help to get a strategy for all your financial goals, the WhatsApp number is flashing on the screen, and we also have an email ID where you can send across your questions. Let's begin the show with a very important segment. The beginning of the month often marks key financial activities, the salary credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. Now, to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, help them secure their financial future, and that is why we just help you so that you can ensure that your SIPs are started, and in fact if you're already investing via SIP, your existing SIP continues. So go on and set your reminder for every month. Stay intact, disciplined, and consistent and committed to your investments, because this is for the financial well-being of you and your loved ones. And as per this particular segment, every week we get you a new topic, and today let's talk about overlapping. So if you think owning 6 to 7 mutual funds automatically means you are well diversified, you need to think again. Today, we decode a silent portfolio killer. That's right, mutual fund overlap. Many investors believe more funds means less risk, but in reality, you could be holding the same stocks across multiple schemes, unknowingly doubling your exposure instead of diversifying it. So, what exactly is portfolio overlap? How do you check it? And what are the do's and don'ts to avoid over-diversification that hurts return instead of protecting them? Let's break it down one by one. We are joined by Amit Kukreja. Amit, hi, evening. Welcome to the show. And yes, we have heard this a lot of time. You know, a portfolio is a case of over-diversification. There is an overlap going on. What do we actually mean by, overlap in mutual funds?
Overlapping in mutual fund means you might have bought 2 or 3 schemes in the same mutual fund category. They might be having an exact similar set or a good common set of stocks as underlying assets in those mutual fund schemes. In our attempt to accumulate more and more mutual funds to diversify and mitigate the risk, we sometimes ending up adding a similar set of schemes. By similar set, I mean multiple schemes from the same category as designated by the SEBI, the regulatory authority, which is SEBI.
All right, so that's overlapping. Amit, we understood, but then tell us something. How different is over-diversification then? Is it the same thing that we're talking about?
See, over diversification, people might think that they are adding more schemes to mitigate the risk. But when you end up adding the set of schemes which belong to the same category, instead of diversifying your portfolio, you're duplicating your portfolio in terms of underlying assets. Now, you might think it's diversification, but actually you are adding more risk to the portfolio by not adding additional sectoral or thematic allocation in your portfolio, either through different categories of schemes or through direct sectoral or thematic addition of schemes in your mutual funds portfolio.
All right. Amit, let's just also understand this from an investor's point of view, because a lot of questions that come on the show, what investors think or feel is that adding more funds leads to more returns. Now, why does adding more funds, makes them feel that they will be earning more, and, if a particular market cap performs and if they have multiple funds of that particular market cap, like we saw a lot when, there were good returns coming in mid cap and small cap. Every investor we saw was stocking up with mid cap and small cap funds. How this in turn can actually backfire and not give you return? How is the overlapping, in fact, curtailing your returns and your profit in your portfolio?
See, so first of all, we have to understand the tendency to add another new set of schemes. What happens is, as a investor who could be planning the financial goals, there are multiple triggers why he would add new mutual fund schemes in his product. One, his existing set of scheme is not performing. They're not beating the benchmark. Two, they might have observed that there is another set of schemes which are cheaper in terms of expense ratios and that have delivered better returns. So they get tempted to add those set of schemes as well, assuming that the base is already found with some previous set of mutual fund schemes. Then they add new so that they have a reduction in the cost and enhancement in the returns. Then sometimes they add because of NFO or because of their own inclination to add a particular theme or sector, because of their own study and research. They believe that upcoming few years could be better in terms of returns in this particular sector or theme. So there are many triggers that make them add these schemes, but what they're not realizing inadvertently, what they are doing is they are basically adding a same set of stocks which are the underlying assets. Just by reducing an expense ratio and adding a same set of stocks, you are better off eliminating the previous scheme and adding a new set of schemes which has delivered better returns. So in an effort to optimize their returns and reduce the average cost, they end up accumulating more mutual fund schemes in their portfolio, which leads to overlapping risk, which is the same set of stocks which are there as the underlying schemes. If they fall, their overall portfolio, instead of giving the benefit of risk mitigation, which they thought they'll achieve by adding more schemes, they will lose that because the underlying set of stocks is the same. If those set of stocks are getting impacted adversely by market movement, portfolio will have a similar adverse impact in terms of returns. So their attempt should be to add only those set of schemes which are adding special risk adjusted return in your portfolio, or an attempt is being made to remove the poor performing mutual fund scheme in the same category, or there is a call in terms of themes and sector which they believe, or a market cap category which they believe will do well. So some homework needs to be done in a DIY model or with the help of some consultant and professional, and then the portfolio be reconstructed or tweaked as per what you're adding in your portfolio.
All right. Let's just also take our viewers through as to how can they check whether the portfolio is overlapping or not. So what are the method or strategies one can do that?
Sure, you can. There is a manual way of going through the fact sheets of every mutual fund scheme that you have in your portfolio. When you go through these fact sheets, you know what are the underlying set of stocks in these schemes and what is an overlap. So when you have 5 schemes in your portfolio, from their respective fact sheets, you can make a little simple Excel file and you can see it for yourself how many stocks are common across these 5 schemes and what is the acceptable commonality of stocks that you can keep in your portfolio in order to have a better risk adjusted return. This is a manual way. There are a lot of online tools. You can even now use the AI tools to identify the commonality of stocks in your mutual fund schemes. Based on these tools or based on these third party websites which share a neutral perspective on the mutual fund performance rather than the websites from the mutual fund companies, you take these third party websites, they have some online screener tools which will tell you the commonality of stocks that you have across these 4 or 5 schemes. So there are many ways you can do that. And it's very easy these days to identify the common set of stocks in your mutual fund schemes and then take course corrective action.
That's right. So, Amit, also, I just want to understand the degree of overlaps, how much is acceptable and how much means a strict no and you need an exit from that particular fund.
Yeah, that's a very good question, Kavita. I'm glad. Just because we are talking about overlapping and just because we are talking about losing the risk mitigation and losing the risk enhancement doesn't mean that overlap is absolutely bad. No, overlap can be an intentional factor created by the portfolio strategist. Because, for example, if you have a large cap allocation through an index fund and through actively managed large cap fund, the two of them might be adding value not only in terms of cost reduction through the index fund, but also portfolio returns augmentation or enhancement in terms of actively managed mutual fund, where the fund manager might be doing a stupendous job of creating alpha over the index in your large cap allocation. It's a good overlap. The index and the large cap fund will have pretty much very common up to 80% to 90% overlap in the mutual fund in the stocks holdings. However, understand fund manager is doing its best to create alpha and the index is doing its best to reduce the cost. So you are getting a dual benefit out of keeping two of them. Similarly, you can identify the set of of active and passive funds in your portfolio, or you can identify these market cap allocation through one flexi cap, one mid cap, one small cap, and one international fund, and a set of large cap funds, or any other combination on the basis of your returns, performance analysis, and study of last 5 to 8 years of these schemes, and then come up with a strategy that actually matches your risk tolerance, because you might not be as risk tolerant as the small cap or mid cap allocation might expect you to be. So you have to do a very careful analysis of these set of schemes, performance, overlap, and your own temperament to weather the volatility in the market.
All right. So, one a very important question now. You suggested that have one fund of every category. But what if the other fund of the same category has better exposure? Then you exit the existing ones and buy the other one. Should that be done? Because once you're checking the overlap, you're also checking the kind of strategies the fund manager has, adopted or maybe just implemented the
Yeah.
philosophy. So how can you go right over there?
Good question, and very common to face this issue when I'm managing my portfolio or people, advisors are managing clients' portfolio. You have to assess what is the financial goal for which you're making this investment. That will give you a perspective on the horizon for these holdings need to be maintained. You have to assess the performance of these mutual fund schemes that you have added, some of them being duplicate, not only from a period of 1 to 3 years, but from the period perspective of 5 to 8 years. If you have data for beyond 8 years, then do analyze. You have to assess how has each scheme benefited an investor in terms of downside protection. And in terms of bull markets, how has this scheme added alpha compared to the index or compared to the category average? Based on the upside alpha or downside protection, period of performance, the style of fund manager, the name and the credibility of the fund house, and mapping it all to your financial goal, which is X years away from today, you will naturally arrive at a right constitution of your portfolio that you need to maintain. Sometimes investors also choose not to sell the old scheme, even though the performance is not satisfactory, because they don't want to pay taxes. They want to defer the capital gains tax payment so that they can compound the returns in the old scheme also, which is still better than index, right? So it's a choice that an investor makes whether to pay the tax now, bite the bullet, and consolidate into one scheme, or it's a choice an investor makes to continue the holdings and avoid payment of taxes, and the combination of X other factors that I was just enumerating a few minutes ago to arrive at the right composition of your portfolio.
All right. I think that will be all. Thank you so much for taking time out and helping our viewers understand the entire concept of portfolio overlap. And for our viewers, it's time for a short break as well. But then post that, we'll be answering your portfolio specific queries. Stay tuned.
In association with Generali Central Life Insurance, your life